you very much. Let me make sure if this is all good to go. There it is. Okay. Okay, great. So, well, thank you very much. Thank you to Rob and thank you, Elena. I really appreciate the opportunity to talk to everybody. And I think I can talk loud enough for everyone to hear me. Can you hear me okay in that? Okay, my wife tells me I usually talk too loud. She tries to get me to shut up. Here it might work okay. All right, so I'm going to talk about investment crowdfunding. I'm going to talk about investment crowdfunding over here. And there will be time for questions at the end. And I'm told that when I'm done giving my presentation, we'll have questions. I'll bring the mic out, and if anyone has a question, come up to the mic, and that way it'll be properly recorded. Okay, so investment crowdfunding. That's what we like to. By the way, I'm Brian Becken. I'm an attorney at a firm called Cutting Edge Capital, which is a consulting firm that helps clients raise capital in accordance with their, in alignment with their mission and values and strategic goals. We also have a sister firm called Cutting Edge Counsel, and most of us in Cutting Edge Capital are also attorneys. And anyway, so we have a law firm as well. All right, so here's what we're going to talk about. Types of crowdfunding, why would you, and by the way, there's lots of different, crowdfunding is a big topic, and when you bring up the question of crowdfunding, usually someone says, are you talking about like Indiegogo? Well, yes, sort of, we'll get to that in a minute, but there's a number of different things that fall under the crowdfunding umbrella. I'll talk about that. Investment crowdfunding is one of those things. Why would you use investment crowdfunding to raise capital for your business? Well, I'll talk about that. A little bit about securities law, just because you've got to understand why things are the way they are. There's a reason, and it has to do with the way the securities laws are structured. I'll make that short, because I don't want to bore anybody. But then that leads into the specific legal strategies that allow you to do investment crowdfunding. And by the way, just spoiler alert, the new Title III crowdfunding regulations, which take effect in May, that's not the only way to do it. There's actually a number of other ways to do investment crowdfunding, some of which have been legal for 100 years. So it's really not new. People say crowdfunding is new, but it's really not. Okay, and then let's see, I'll talk a little bit about the process, and I'll go ahead and cover some questions that everybody always asks, and then, well, I already told you about my firm. Okay. What is crowdfunding? Basically, the idea is raising small amounts of money from many people rather than large amounts from a few. That's sort of the basic definition. Like the graph shows, a little money comes a lot of people, power of crowdfunding. Okay. So that's a broad definition. So there are a number of different kinds of crowdfunding. The one that people tend to know most about is donations. Donation-based crowdfunding. Examples like there's lots of donation-based crowdfunding websites. Donors Choose is one that's kind of cool. You can donate to a school and to buy computers or crayons or whatever they need for the school. It's a great thing. You don't get anything back. You don't nothing in return. It may be tax deductible. That depends on the way the crowdfunding portal is set up. Works great for nonprofits. That's donations. Rewards and pre-sales and that kind of thing is really popular now. So, when you go on to Indiegogo and Kickstarter and, you put in $500 and you get a signed t-shirt or, whatever, an autographed record from your favorite up-and-coming band. That's what we're talking about here. Rewards-based crowdfunding. It's not an investment. In fact, if you read the fine print on Kickstarter and Indiegogo, which are great sites, by the way, I love them, but if you read the fine print, they forbid investments. You are not allowed to the contributors are not allowed to get their money back. You can't get a return on investment. You can get some cool stuff. Here's an example, one that got some notoriety not too long ago, the Oculus Rift. They did this extremely successful crowdfunding campaign on Kickstarter. Raised $2 million. That's not typical, by the way. Most crowdfunding campaigns on Kickstarter and sites like that raise 10,000, something like that. But these guys did really well. Raised $2 million. Not long after that, the company sold for about $2 billion. Billion with a B. Did all those contributors get a piece of the action? No. Didn't get anything. Why? Because it wasn't an investment. They just, it was a pre-sale. All they got was this thing, whatever that thing was. I don't know that much about it. You guys probably know more than I do.
Which became useless, by the way, because they went to the next route and the old one wasn't supported.
Yeah, okay, so it ended up being pretty useless, and so a lot of people were pretty unhappy about what happened there. But the point is, you can't get your money back. It's not an investment when you're doing rewards and pre-sales and that kind of thing. All right, peer-to-peer lending is a kind of it's sort of like investment crowdfunding, but it's really sort of a hybrid because it's more, in some ways, it's more like a commercial loan. If you go on to Prosper a lending club and get a loan, it's as if your peers are lending to you, and in reality, you're at the bank lending to you, and then the bank sells the loan to Prosper, and then, or a lending club, they kind of work the same way, and then investors, invest, and they have this payment-dependent promissory note. It's cool. I've used Lending Club. I'm a fan of them too. Great organization. They control the terms of the investment. They started out only loaning to individuals. I think they're expanding into business lending. So it may be possible to get a commercial, to get a business loan from one of the peer-to-peer lending sites. But investment crowdfunding, when we talk about investment crowdfunding, that's a real investment. Investors can get their money back, get a return on their investment, and the entrepreneur decides what the terms of the offering is. So that's what distinguishes it from peer-to-peer lending. You can offer whatever you want. It's open to accredited and non-accredited investors. And as I say here, some types can be advertised. Now, there's some caveats to that. But generally speaking, when we're talking about investment crowdfunding, we're talking about a public offering that can be publicized. You can offer the opportunity to your whole community, whoever that may be, your neighbors, your customers, whoever that is. Anybody can invest in this type of crowdfunding. Okay, now within investment crowdfunding, there are some other types. There are several different types, and I'll get to those in a minute. But first, why would you raise money this way? The traditional means of getting capital, either go to the bank and get a loan, or you go to a VC firm and get a big investment, and that works. And that sometimes that is the best and most efficient way of getting capital. But for some kinds of companies, that doesn't work. Why? Well, banks may require too much profit. They'll insist on seeing profit before they'll loan you money, typically. Or too much collateral. I mean, if you have real estate in business, great. Banks will lend you money all day. But if you don't have real estate, you're going to have to find some collateral. Personal guarantees, that kind of thing. Yeah, that may be a hard pill to swallow. Institutional investors tend to require too much control. They want too much back. They'll dictate the terms of the investment. And, see, here's the thing. A lot of times the VC investment model is designed to look for those hugely successful companies, the Facebooks of the world, the ones with the hockey stick growth potential. And if you don't have that kind of growth potential, you may be told you're not fundable, which is a shame because there's a lot of really good, solidly profitable ideas out there that should be good investments, but they have a hard time. You have a hard time attracting investment because you can't demonstrate a potential for that kind of hockey stick growth that the institutional investors are sometimes looking for. Other crowdfunding methods don't allow you to control what it is you're offering to your investors. So, okay, why crowdfunding investment? Here's another one. You get to keep control of the offering and of your company. You can offer anything you want. You can offer debt, you can offer equity, and within equity it can be common stock, it can be preferred stock, non-voting, voting, preferential dividend. It can be a revenue share type of security where your investors invest, and instead of getting a fixed rate of return, they get some pro rata portion of your profits. There's a lot of flexibility, and you can structure it so you can never lose control of your company. In other words, you don't have to run the risk of losing control of your company. You can set it up in such a way, even if you're going to be offering common stock, common voting stock, there's some things that we can do to make sure you don't lose control of your company. You can set you up a super voting stock, and then you can offer common stock. so that your shares are getting 5 votes per share or something. There's different ways we can do it so that you stay in control of your company. And part of being in control of the deal is that it's in terms of non-negotiable. When you have an offering out there, a direct public offering or another type of crowdfunding, you can't have an investor come in and say, well, I'll invest, but I want this and that and the other. No, it doesn't work that way. What you offer is what everybody is offered. Everybody gets the same deal. It's not going to be, you don't have a big investor who's going to dictate the terms. All right. Again, why crowdfunding investing? Investment crowdfunding? Engage your community. And this is one I love, and it's because, as I say here, investors are great customers, investors are great ambassadors, and it kind of works the other way too. Customers can be great investors. Now, for a picture here of a little brew pub. We actually have several clients at our firm that are in the brewing business, restaurants, breweries. And the thing about those is they have a customer base that loves them. And if they want to raise capital, who better to invest than the people who really love their beer? I mean, if you love beer, you want to invest in it. So, okay, that's just one example. But the point is, a lot of companies have a network, have a community. And that can be defined any way. It can be your geographic community, literally your geographic neighbors. It can be, sort of affinity groups, people, organizations that you're a leader in, and whatever it looks like to you, your customers, your suppliers, those are all part of your community. And if they love what you're doing, they might make really good investors. Contribute to a healthier local economy. This is another one that I think is really cool, and not everybody thinks about this, but if, and this is true, say, if you're a locally focused business, and a lot of businesses aren't locally focused, they want to sell their product nationwide, worldwide, whatever, and that's totally cool. But if you're talking about something that has a local character, this is a way of improving the health of the local economy. And that can be kind of a cool thing, particularly if you're talking about a restaurant, a brewery, or something like that, or anything that has a local focus. The multiplier effect, when you have investors investing in a business and they're getting the profits and they spend the money in the community and they contribute to local charities and local schools. Everybody in that community benefits. It's kind of a good thing. And it hedges against global economic gyrations too. That's another story. We won't get into that today. All right. Another reason to go with investment crowdfunding, and this is one that I think is really cool. It provides non-accredited investors with values-aligned investment opportunities. And the thing that, the reason why this is important is because if you're a non-accredited investor, in other words, you have less than $1 million in assets or less than $200,000 in income, which is about, by different estimates, 95, 97% of the population. If you're, whoops, you hit it accidentally, thank you. If you're a non-accredited investor, you may have almost $1 million in investable assets, but you don't have a lot of investment opportunities because all the good opportunities are available only to accredited investors. That's the way the securities laws are set up, except for crowdfunding opportunities. And this is where you can contribute to something bigger than just your particular company or your particular project. You can contribute to a more equitable and democratic economy by opening opportunities for anybody to invest in a local business, invest in something they believe in, something that's values aligned. All right, so we'll talk just for a moment about securities law because that's what drives all. The reason why Indiegogo and Kickstarter don't allow investments on their sites is because they don't want to deal with securities law. Securities law is that big barrier that prevents people from doing things. All right, the general rule is any investment opportunity, basically anytime you're talking about investment, you're talking about securities. Think of securities as basically a synonym of investment. If you're talking about investment or you're going to get some return on your money, you're dealing with securities law. Any investment opportunity must be registered or exempt from registration with the regulators at both the federal and the state level, with the caveat that some federal exemptions preempt state law. I'll get to that in a minute. It's complicated, and you don't want to go down that road without good legal advice. So, what are the strategies that allow you to do investment crowdfunding? Well, there's 6 here. There are actually a couple other minor ones, but these are the ones that are really significant. The first one there is the newest, and I'll just mention it first because that's what everybody's talking about. The Title III of the Jobs Act. And this is a new exemption from the federal securities registration requirement that, well, you know what, I'll get to the details in a minute. But let me just go down the list here. State-specific exempt crowdfunding. A lot of states have adopted their own crowdfunding exemptions. California has not. Our firm actually helped to write a draft, some legislation, or a bill at least, that was considered by the California legislature last year, but anyway, it didn't get passed, so we're back to ground zero there. But at any rate, there's a lot of state-specific crowdfunding laws. Well, okay, we'll talk more about that in a minute. The other exemption is the nonprofit, direct public offering, the intrastate direct public offering, well, 504 and Reg A. Reg A is the other new one. Let me talk about those in more detail, but first, 2 other common strategies that aren't crowdfunding, but just to sort of round out the picture because people talk about them. Rule 506 offerings to accredited investors. And the reason I mention that is because there's a lot of so-called crowdfunding portals out there. And I won't name names, but there's probably dozens, there's probably hundreds of them, that claim to be crowdfunding, but if you read the fine print, they're only open to accredited investors. Well, this may just be my opinion, but an investment opportunity that's only open to the richest 2 or 3% of Americans isn't really crowdfunding, in my opinion, but whatever. Anyway, so a lot of the crowdfunding portals are out there aren't really crowdfunding. All right, private offerings, friends and family raise, that's not crowdfunding either, but that's, you know, that's the low-hanging fruit. If you've got friends and family with money to invest, go for it. That's the easiest way to raise money. Okay. But now down to the details. Those are Jobs Act Title III crowdfunding. So these rules were just finalized, just issued in final form on October 30th. So just barely a month. They go into effect in May. It's a new exemption. It requires the use of an intermediary portal. You can't just go out and do your own crowdfunding on your own website. You have to use a third-party portal. And by the way, they're probably going to charge a fee of somewhere 5 to 10%. You know, I don't know if anyone's going to go less than 5% because they have to do a lot of due diligence. They've got to cover their costs. So it's going to raise the cost of your raise. $1 million cap over any 12-month period. It does require CPA-reviewed financials if you're doing offerings over $100,000. There are per investor caps you got to kind of be aware of. 5% if their income and assets are under $100,000, or 10% of their assets if they have over $100,000 in assets. So you know, there are a lot of commentators who have said, yeah, it's great, but it's not going to be very useful. Not many people are going to use this. That remains to be seen. I don't know. I mean, I've heard a lot of people say no one's going to use it. Maybe they will, maybe they won't. We'll find out after May. State-specific exempt crowdfunding. The reason why these laws all came into existence, this has all happened in the last 3 years, is because the SEC dragged their feet on the Title III of the Jobs Act crowdfunding rules. The 2012 Jobs Act required that the SEC issue rules within 12 months of the law being passed, and I think that would have taken us up to around January 2013. They missed their deadline by about 2.5 years. In the meantime, a lot of states said, let's just set up our own crowdfunding rules. So about 25 or 30 states have. They're typically very similar to Title III, with the exception that you can only raise money under those rules in one specific state. You can't cross state lines. The advantage of going with Jobs Act Title III crowdfunding is that you can cross state lines. So my suspicion is that now that Title III is becoming effective as of next May, not many people are going to use those state laws, but again, that remains to be seen. All right. Now we get into direct public offerings. And the reason I distinguish direct public offerings from exempt crowdfunding is because typically when we talk about a direct public offering, with some exceptions. Typically, we're talking about an offering that's actually registered at the state level. We're not using an exemption. We're actually registering at the state level, which, by the way, is far, far easier than registering at the federal level. If you're talking about registering with the SEC, you're talking about a full-blown, IPO, filing an S1 registration, and it's, hugely expensive. It's not something small businesses can do. But state-level registration is usually easier, by a couple orders of magnitude, easier and cheaper. So that's typically what we talk about when we talk about a direct public offering. Let's see. Okay, but now, nonprofits have a special exemption at both state and federal level in most states. California, unfortunately, does not have an exemption. So in California, you can be exempt from federal law as a nonprofit, but you're not exempt from California law. You still have to do California level registration. It works great for a nonprofit investment fund. I actually was in-house counsel for 6 years at RSF Social Finance, and we did an investment fund, raised about 80 million, something like that, very successful nonprofit investment fund. If you're talking about creating an investment fund, definitely you have an easier time as a nonprofit because you not only have an exemption from the laws regulating issuance of securities, but you also have an exemption from the Investment Company Act of 1940, which, if it wasn't exempt, would make it impossible for an organization like RSF, Calvert, and other similar organizations to do that. All right, anyway, let's see. So that's the nonprofit. The intrastate. This is actually probably the most commonly used strategy for investment crowdfunding, the intrastate offering. And the reason is because, compare this with the crowdfunding exemptions. This is much more versatile. Right now, there's no maximum. You can raise any amount of money. Like I mentioned here, the SEC has proposed to limit it to $5 million. We think that's a bad idea, and we're going to write a letter opposing that change. We don't think they're going to do that because we think there will be a lot of outrage over that. Like, why should the federal government be telling states, how much can be raised in their state? It doesn't make sense. The caveat is that when you do an intrastate direct public offering, all investors must reside in the same state as the company raising capital. 80% of their assets have to be in the same state, and you do need to register at the state level. So you're exempt at the federal level, you register at the state level. All right. Reg D, Rule 504. People talk about Rule 506. Rule 504 is not to be confused with Rule 506. It's totally different. Rule 506 we mentioned before, that's the one where you're doing accredited, you're offering only to accredited investors. Rule 504 allows you to do a true direct public offering. You do have to register in each state, so the major downside is Rule 504 has a $1 million cap. The SEC this time is issued a proposal that goes in the right direction. They're proposing to raise the cap to $5 million, which I think everybody's going to support. All right, so let me just go through the rest of these pretty quickly because I don't want to bore you with all the specific legal strategies. I just want to give you a sense of the lay of the land here. Reg A is another new one. Everyone's talking about Reg A. At least a couple months ago when this was finally finalized over the summer, everyone's talking about, wow, for the first time ever, non-accredited investors will be able to invest in their community. Well, I love the fact that it's being publicized that first time ever. That's not true. I've said investment crowdfunding has been legal for 100 years. But this one is getting a lot of press. If you're interested in doing bigger DPOs, we can talk about the details. These allow you to raise up to $50 million. It's a lot more expensive because it does involve kind of a mini registration with the SEC. Just leave it at that for a moment. Okay, what's the process of doing a direct public offering? Basically, what our firm does through a standard intrastate direct public offering, we take in a client. We first do some compliance review, make sure they've got all their securities filings for past issuance of securities. Most companies haven't done it all correctly, so there's often some cleanup to do. help them figure out what kind of security to offer. Do you want to do debt, preferred stock, common stock, revenue share, whatever you want to do. Figure out your compliance strategy. Those are the things it's talked about. Interest rate, 504, depending on how much you want to raise, where your investors are. We help you work through that. We prepare the offering documents. The main one there is your offering memorandum. That's that document. It can be anywhere from 20 to 50 or more pages, but it includes all the information that an investor would need to know to make a decision. Basically, all material information, about the company, your strategy, your competitive environment, your particular competitive advantage, your budget, your management team, management ownership of stock, your management compensation, all this kind of stuff that people would want to know is all in there. Long, list of risk factors. We basically make sure that investors know all the things that could go wrong. That protects you, by the way. That protects you by making sure that you can point to a black and white document where you've disclosed all the things that could go wrong. And then we package that up with all the other documents that need to be included in an application to the regulators. We submit that as an application. And then the regulators, there's some back and forth, typically over a couple of months until you get the permit. In some states, it's easy. They don't scrutinize things too terribly much. In some states, like for example, Colorado, basically if they don't respond within 10 days, it's deemed approved. In California, they take a very different approach. They scrutinize things intensely, and they take a very proactive approach in reviewing applications with a view toward making sure that investors are going to be adequately protected. We usually get a couple of rounds of back and forth from California regulators, and then at the end of that process, they issue a permit. And then once you've got your permit, you're totally legal. You can launch your public offering. You can start advertising. You can actually put ads in newspapers, Facebook, social media. You can do these things and bring in investment. So that's the DPO process. All right, let's see. All right, so what are some of the questions we often get? Is it new? Well, as I mentioned before, no, actually it's not. There's basically, states have had their own securities offering process for 100 years, for over 100 years. It's not really new. Like I said, there's a lot of misinformation in the media. When the Jobs Act, when Reg A came out, and again, just a month ago when the Title III crowdfunding regulations came out, again, people were saying, oh, the first time ever you're going to be able to invest in small companies. Well, like I said, that's not quite true. In the 80s, Ben & Jerry's did a direct public offering. Other companies like, People Exchange, Andy's Homegrown, there's a number of them that did it in the 80s. It had a surge of popularity in the 80s. It kind of went out of favor in the late 90s and early part of this century. Presumably because of easy money and it just kind of got ignored. But it's coming back now. That's what our firm specializes in, and we're seeing a definite upswing in a number of companies who are interested in doing something. So it's coming back. A couple strategies are new. Title III and the Reg A plus the new Reg A. Those are new, but the others, interstate and 504, the nonprofit, those have been around a long time. Will a company become a reporting company? People are always worried that they're going to have huge compliance burden. Well, the answer is no. No. When you do a direct public offering, you don't become a public reporting company. You're not subject to the SEC. You're not going to file a 10K, 10Q, 8K, all that stuff. You don't do all that. Even when you've done a direct public offering, you're still essentially a privately held company. Now Reg A has its own reporting requirements. We can talk about that if anyone's interested in Reg A. That's sort of, like I said before, it's sort of a mini registration, and you have some ongoing obligations. But the other strategies don't have that kind of high level of reporting obligations. But the caution here is, if you have over 500 non-accredited investors, equity investors, or over 2,000 total equity investors, you do become subject to the SEC's reporting requirements, that you become an SEC reporting company. And Thanksgiving Coffee Company is one of those that did a DPO, had over 500 non-accredited investors, and became an SEC reporting company. Not that that's necessarily a bad thing, but there's an example of a company that did become a SEC reporting company. We advise our clients not to, so we cap the number of investors. In the offering documents, we say we won't take in over 500 non-accredited investors. Is it risky to have non-accredited investors? There's sort of a myth out there that somehow you're more likely to get in trouble, get sued or something with non-accredited investors. We have not seen that at all. In fact, we have not seen any example of a crowdfunded company getting sued by their investors, by their non-accredited investors. Not one. I mean, typically, when you're investing $1,000 or $2,000, you're not going to hire a lawyer to sue if things go badly. And perhaps more, and maybe that's not, that remains to be seen. Maybe, you can probably have a class action lawsuit or something. But really, the point is, when you're going to your community to raise capital from the people who love you and support you, they're investing because they support what you're doing. They're not just investing because of some hope for, triple-digit profit someday. It's a different thing. It's a different field. All right. Will DPO investors tell me to run my business? No. You remain in control. As I said before, you offer what you want to offer. You can offer non-voting preferred stock. You can set it up in such a way that your investors don't have any way to vote you out of the company or outvote you on the board. I mean, you can set it up so that you stay in control. All right. What's the exit? That's a lot of people's question. How does an investor get out? Well, there's actually a lot of ways to do that. You have a built-in exit. So if you offer debt securities, investment notes, it'll have a maturity date. It's sort of built into the security that you're going to eventually pay out your investors. You can have a redemption feature in the security itself. So if you're offering preferred stock, you can design a preferred stock so that at some trigger in the future, you can buy out your investors. And it doesn't have to be all at once. You can do it in phases. The company sometimes will get acquired. This just happened not too long ago with Annie's Homegrown. That's, the cute little packages of macaroni and cheese and stuff. They did a DPO sometime in the 80s. They recently got bought by a big company, and all those DPO investors, I think, did pretty well. IPO, sometimes, companies will do a DPO in the early stages and then later do a full-blown IPO, meaning federal SEC registration. And even if you don't do any of those things, there is some opportunity for investors to trade back and forth. In fact, we know of at least a couple of companies that have done a direct public offering and have a bulletin board on their website where investors can say, hey, I'm interested in selling my stock or whatever. The caveat there is, of course, investors who want to sell their shares do have to comply with securities laws. You've got to make sure that you know what you're doing there. All right. What ROI are investors expecting? Well, as I say here, it varies. It's not a single investment class, so you can't say, well, they're expecting 5% or whatever. I mean, our clients have offered 2 or 3% for some companies. Other companies have offered, that's a note paying 2 or 3%. Other companies have offered, preferred stock paying a 10% preferential dividend. It can be, whatever you think will attract your investors, and you got to sort of think about sort of how you fit into the whole, investment landscape. What will attract investors? Typically, our clients at least aren't offering the potential for hockey stick growth. They're not, even hinting that, investors could make a killing someday. That's not really what it's all about. I mean, that would be a nice thing, but that's not really the focus here. These are typically solid companies who can reasonably expect to get profitable, but they may not be, paying 10 times the investment at any time in the foreseeable future. That's just not on the radar screen. Pay in kind. You can. It's kind of an interesting one. We have a client who's essentially it's a company that owns organic farms, and they deliver farm fresh to you. Some of you may know them. Some of you might get their box of produce every week. But my family gets it. It arrives on our doorstep Monday morning. It's really cool. They did a direct public offering, and they offered basically to pay interest in produce. So you can, and they offered a premium, by the way. They paid a couple of extra % if you take your interest in kind, in produce. There's different things you can do with that. You can get creative. All right. Who can do a DPO? Well, any kind of entity, LLC, corporation, whatever, partnership, early stage or mature, it doesn't really matter. It works fine for early stage companies. It works best for, we skip down the bottom here. You need to have a compelling story, to get people fired up, get people interested in supporting what you're doing with their money. Either have a compelling story or have an existing network of people who already support what you're doing. So have one or the other. Have a great story or have a network. Have a community that wants to support you. And so if that's true, you can be in the very earliest stage of your company, but as long as you either have a great story or a network, it's not hard to sell an investment. Raises anywhere from 250 to 50 million. 50 million is just because that's the cap on Reg A. Although, as I mentioned, RSO Social Finance did their investment fund, did essentially a DPO that raised way more than 50 million. But anyway, I put 50 million. 250,000. You probably can't cost effectively do this for much less than that. At least not a direct public offering. If you want to do exempt crowdfunding, like title-free crowdfunding, yeah, you can probably do that cost effectively for, do a raise cost effectively for less than 250,000, maybe, 50 or 100,000, depending on what, depending on, what the fees are going to be for the portal that you choose and so on. But anyway, that's the rule of thumb that we generally go by. Any industry, any state. Every state, by the way, has its own laws. So you do have to pay attention to what, figure out what the laws are in the state you're in, and figure out what exemptions you can use there, or registration process, as the case may be. All right, about our firm. I think I already talked about this. Cutting Edge Capital. We're a consulting firm that helps our clients raise capital in alignment with their own goals. We have a law firm called Cutting Edge Counsel. We're mostly the same people. We switch hats back and forth depending on what we're doing. We specialize in security compliance. We do other stuff too. Cutting Edge X, I mentioned that because that, as far as we know, is the nation's only listing site for direct public offerings. You can go there. There's about 15 or 20 direct public offerings listed right now. Not all of them are open to California investors, but I think about half of them are, I think. We have clients all over the country. And actually, Cutting Edge X is not just for our clients. It's a listing site for any direct public offerings that want to list on it. Even if they're not our clients. So we want that to be, and by the way, we do that without any compensation. People don't pay for it. We just want to help get the word out about direct public offerings. So there's no fee for that. It's a little listing. Anyway, Cutting Edge X, check it out. Interesting stuff. We have some really cool offerings. All right, and that's all I have. And if there's any questions, come up to the microphone, because the reason is because this is being videotaped, and even though I can hear you well, the video machine won't.
So my questions are about regulation. I understand that you help with the filing. Who sells it, and what kind of licensing is required?
Okay, good question. Well, when you go through all the compliance hoops and you get your permit to do a direct public offering, that is your license. Then you can...
So anybody can sell it? You don't need a securities license?
Okay, well, your executive officers. So you raise a good point. You can't have a lot of people going out and selling it on your behalf.
Mhm.
When you do a direct public offering, basically, someone who is selling an investment opportunity has to be licensed as a securities, have to have the right securities license. But there's an exemption for an offering made by an issuer's own executive officers. Now this varies from state to state, but that's typically the case. So in California, if you're doing a direct public offering, you personally, even if you have no securities license, if you're the CEO or an executive officer, you can go out and talk to potential investors.
Okay, so, and there's no compliance review in terms of advertising? You put it on
Oh yes,
Yeah.
yes, you do. Any advertising we send,
Reviewed.
we
Okay.
send to the regulators, they review everything. This is not like under the radar. This is a fully registered offering, the regulators review it. Yeah, this is not an end run around the laws, this is not a loophole, this is a fully registered, when we do a California DPO, it's a fully registered offer.
And
They
you
re-
handle the compliance?
That's what we do, yes.
Okay, all right, thank you.
Sure, sure.
Hi there. So I had a quick question about the stability of the company because for investors, for accredited investors, it's often a risk analysis. So when you have, say you 500 people who've done micro investments, and as much as I love Jim Bob from Texas, my cousin who invested in my company, investors further on down the road might not want to see that Jim Bob is helping to decide the direction for my company. And so does it kind of shoot yourself in the foot by having other people, or so many people being, I guess, included into the investment pool in the circle directing the company? Or is there a way to kind of default that?
Well, typically, you can set this up however you want to, but typically for most of the direct public offerings that we do, they're not typically issuing voting stock. Some of them are, but the answer is it's not an issue because investors aren't going to have the power to basically dictate how you run your business. You're going to set it up in a way so that you can get the advice that you need, but for example, if you issue non-voting preferred stock, which a lot of our clients do, they don't have voting power. They are truly passive investors. So someone who's coming in looking at your company as an acquisition, they're just going to see a list of passive investors. It's not really going to be an issue. These aren't, Jim Bob isn't going to be basically telling you how to run your business.
Awesome. Thank you.
But it's good to get his money.
Have any companies done a DPO with regulation A+ yet?
No, but if we go back to my slide on that, actually, I forgot to mention that. I had showed a little picture of this motorized electrical three-wheeled vehicle. That's Elio. Elio Motors is, I don't know if they're actually the first, they're not a client, by the way, but I think they're one of the first to use Reg A. The Reg A just came into effect over the summer. Nobody has actually completed an offering under Reg A. So it's still kind of a mystery sort of what the regulatory process is going to look like with the SEC. The SEC probably doesn't know how they're going to handle some things. But they're one of the first companies. They haven't, I don't think they've actually launched their offering yet, but I know that they're in the process of it. So a lot of it remains to be seen how Reg A is going to be administered.
So if you do Reg A+ and you go public, you raise $50 million, and you issue stock, I guess you have some formula for determining the value of each share of stock. Then how liquid is it, and what determines the price of the stock in the future?
The stock isn't going to be traded on a so when you do a direct public offering, you're not listing your stock on an exchange. That's different. That's typically what happens when you do an IPO. These shares are still, as I said, essentially privately held, and so there isn't really an established market value. Now, you raised a good question, how liquid is it? Well, not very. It's not, investors can sell them, but there isn't a market where they're listed that they can sell them easily. And they do need to comply with securities laws. So these are typically not highly liquid investments, to be totally honest. These are relatively illiquid.
Is there an opportunity to build a website to make like a market for those stocks?
Yes, if you want to go through all the trouble. Yeah, so on the new Jobs Act, if that's what you're referring to, the new Title III crowdfunding provisions of the Jobs Act has.
Regulation A plus. More interesting.
Oh, well, you're talking about Reg A plus. Reg A plus can be done, you don't necessarily have to use a third-party portal. And that's true of direct public offerings too. So you don't have to go
They
through.
want to market for it after they offer it.
Okay, you're asking, could someone create a marketplace for shares that have been issued in direct public offering? Yes, but that's very complicated, and if you want to be the first to do it, more power to you. Nobody's done it yet. A lot of people have been trying to figure out how to do it cost effectively. No one's figured it out yet. You want to click off the mic?
Well, could you go through those, the ways in which investors do get compensated and cashed out again? I mean, is it all predetermined? Is it all a matter of, I'm going to give you 3% of my profit over this period of years, or I'm going to give you a certain percentage a year, or?
Okay, so the question is what are some of the ways that investors can get their money back? And like I said, go ahead if you want to embellish that. No. There are ways of doing it where the return on investment is built into the way the security is designed. And sometimes that can be the easiest way to do it. For example, if you issue investment notes, debt matures at a certain date. And that, on that date, the company will pay it back, back the investment with interest. Preferred stock sometimes has a redemption feature. So the stock, at 5 or 7 years, the company can redeem the stock and buy it out. And then, so a couple of the other ways that investors can basically get cashed out is via an acquisition, and that does often happen. A company will, if it's successful, it'll get acquired by a bigger company, or do an IPO. And even without the other alternative to any of those is shareholders can potentially sell their shares. It's just that they need to make sure, because these are not listed shares. It's not just a matter of calling up your stockbroker and saying sell my shares. You got to make sure that you're in compliance with securities law. So the shares can be sold.
Can you give us an example of how did Ben & Jerry's do it?
Well, Ben & Jerry's got bought out. So I'm not sure if there was any liquidity event before they got bought. I think they got purchased by Unilever, if I remember it correctly. Wait, no, I could be wrong. Anyway, it doesn't matter who bought it. But the point is, all those investors in the direct public offering, they all got their shares bought out.
That wasn't their intention when they made the DPO, though, I don't think.
No.
They must have had some plan for eventually paying investors, recouping their investment, right?
Yeah, Unilever.
Was it Unilever? Okay. They may have. I'm not sure what their plan was. I don't know. It's a good question. I don't know.
My question is, why would people invest in something like this? I mean, the motivation part of it to the investor is mysterious to me.
Well, like for example, one of our clients is Water Effects. Water Effects is a great project. They're building a solar desalination plant in the Central Valley. It's desperately needed.
Yeah.
And they're raising. They have a pilot plant. They're raising $10 million to build full-size utility scale plant. And they're issuing preferred stock that pays 6% dividend, and there will be a redemption feature at 7 years.
Okay.
So why would I invest? Because 6% is pretty good.
Dividends, sure.
Yeah. If it's note, it's the interest. I mean, you get a return on investment. Not all of them do. I've got another client who's doing a direct public offering, issuing common stock in a company that's building electric vehicle charging stations up and down the coast, the Sun Trail. Common stock, there's no promised exit there. the hope is that the company will succeed, will grow, and eventually get bought out. That's probably the likely exit strategy. They'll get bought out, or, maybe they'll do an IPO, but more likely to get bought by a bigger company. So it varies. It varies. It's, it's what, as the entrepreneur, it's whatever your vision is for the company. Someone else was.
Okay, much simpler question. What are the costs range associated with doing DPO depending on the regulations?
Well, for a typical intrastate offering, depending on the size and complexity of it, the cost, like our firm's fees can be anywhere from around $15,000 up to, $75,000. It depends. A Reg A is going to be more expensive, but for a standard intrastate offering, probably less than $50,000.
Okay. So this is what you would charge, but what about the charge by the government institutes to do the?
Oh, the filing fees of the regulators? It's a formula that's based on the size of your offering. It's capped at $2,500. So no matter how big your offering in California is, the filing fee, the regulatory filing fee, can't exceed $2,500.
Oh, okay.
Every state's going to be different.
So, will you make your slides available for us?
Sure. I'm happy to send you slides, yeah.
Okay, and then the second question is, you think that that's the only DPO site is cutting edge X that you know of right now?
It's the only one that we know of. Yeah, if you know of any other, I'd be really interested to hear about it, but I don't believe there is.
So my question follows on the gentleman up here on the upper left, that a common statistic bantered about is 10% of startup companies that are VC funded, actually succeed. So these VC firms are investing in many, many startups and hoping that one of them is going to get tenfold return, or a hockey stick even more than that, or whatever. So I'm just curious, you told us here that DPOs typical return 2 to 10%. What about the number of companies on cuttingedgex.com or your customers are actually succeeding, to just compare the risk reward?
Yeah, that's actually a really interesting question, and our experience has been that not one of our clients has yet failed. That's not to say that they won't. Of course, some will, but none have yet. There's an interesting discussion to be had about why the VC's track record is so poor, and it may have something to do with the VC funding model more than because they only fund certain kinds of companies that are higher risk companies, perhaps. The companies that come to us to do a direct public offering aren't interesting to VC firms typically, or less interesting because they don't have that potential for hockey stick growth, but at the same time they may be much lower risk. And like I said, we haven't had one fail yet.
This is actually to follow up on the question that asked if cuttingedge.com is the only site for DPO. So there's a site called formsd.com that's got a list of all these companies that have filed a Form D. So maybe you can explain what the difference is for that versus DPO.
Okay, so what they do, most likely those are all Rule 506C offerings. 506C is probably by far the most commonly used strategy for companies for small businesses raising growth capital. And that is the classic private placement to accredited investors. Now, there's a twist on the private placement aspect of it. Rule 506, so there used to be just Rule 506. And then as an outgrowth of the Jobs Act, there's now a new variation on the private placement rule called 506C. So now we distinguish between 506C and 506B. 506B was the traditional private placement that does not allow any kind of advertising or general solicitation. In other words, you can only talk to people that you have a substantive pre-existing relationship with. And you technically could have some unaccredited investors, but the rule of thumb was don't go there because your compliance burden ramps up if you have even one non-accredited investor. That's all under the traditional Rule 506B strategy. So with the Jobs Act in 2012, the SEC issued new rules that created a new category that we call 506C. I know it gets confusing, but 506C is like B, except that you can advertise and do general solicitation. The flip side, what you sort of give up, is that when under 506C, you not only can't have any non-accredited investors, but now you have to affirmatively verify that every investor is accredited by reviewing the tax return, by getting a letter from their investment advisor, attesting to their $1 million in assets or whatever. So there has to be some additional hoops you jump through now. But the reason I'm getting to that is those are all under Regulation D. So those are all offerings that would file a Form D. And so that's why I think that site probably refers to, and as I mentioned, a lot of sites that purport to be crowdfunding sites are really just doing Rule 506C offerings. So this is probably one of those, and whether they use the term crowdfunding or not, I don't know. But those are offerings that are only available to accredited investors.
Yeah, it's not a crowdfunding site, it's just a site that you can find companies that have filed a Form D.
Yeah, and so there's a few out, and those are great. Those are great. I mean, the only thing is, if you don't have that $1 million in assets or $200,000 in income, you're out of luck. You can't use it.
Okay, and I have one more question, and I'll give up the mic. So the nature of my job, I sometimes see like operating agreements for private, companies that are looking for investors, right? It's with self-directed IRAs typically, and they'll have on the agreement it might have something about being an accredited investor, like they have to check like how they acquire, or it'll have a paragraph where they're not accredited, but they have the necessary expertise, or some wording along those lines of being able to invest.
Yeah.
And is that just some special thing, or does that meet the legal requirements?
Well, those are not direct public offerings, because those are limited to typically accredited investors. Although, there is actually a provision in California law that allows you to sell an investment opportunity to people who are not technically accredited, but meet some sophistication and requirements. So I would say that's not what we're talking about here. That's not a direct public offering. That's not crowdfunding, because the essence of crowdfunding and direct public offerings is anybody can invest. You don't have to necessarily you don't have to have $1 million in assets. I should say, however, though, I know a lot of people are concerned, well, doesn't this open up the floodgates for fraud, and aren't you going to be, little grandmothers are going to be giving up all their investment. There are a lot of safeguards in place, even for direct public offering. There's always suitability standards. In California, the regulators scrutinize the suitability standards very carefully. So even though in California you don't have to be accredited to invest in a direct public offering, there are some standards, typically the regulator, and this is up to the regulators to decide what they want to impose, but typically the rule is if you have over 150,000 in assets or something like that, you can invest up to 10% of your investable net worth. If you have less than that standard, you can't invest more than $2,500. So the idea is, even though it is truly open to the public, we still don't want people investing their whole life savings in one deal, which would be totally inappropriate for them. So there's always going to be suitability standards, even in a direct public offering.
Yeah, I'm trying to understand what would happen as an investor if the company I invested through in a DPO gets bought by a publicly traded company.
Mm-hmm.
So would all of a sudden I get all my shares converted into real publicly traded shares from that new company?
Probably. I mean, it can be done a couple ways. It can be done, so when a larger company acquires a smaller company, they typically do, they call a tender offer, and they basically offer to buy everyone's stock. And they can either pay for it in cash if they've got a lot of cash in their treasury, or perhaps more commonly, they buy it by exchanging it for stock of their own, that is, of the bigger company. So, yeah, typically, as an investor in a DPO of a company that's now being acquired by a bigger company, your shares are going to be exchanged for shares in the acquiring company. Yeah, yeah. Sometimes it'll be cashed out, but more likely exchanged.
Two quick questions. Is cuttingedgex.com, that third-party intermediary that you mentioned, DPO regs require one to have? And is there a 5 or 10% perfunctory fee that's associated with Cutting Edge?
Okay, so cuttingedgex.com is not actually a Title III crowdfunding portal. That's just a listing site for direct public offerings. And we don't charge anything for a listing, so we're actually talking about two different things. Right now, I'm not aware of any crowdfunding portals that are going to be doing Title III crowdfunding deals, but it's too early to know. I'm sure, I have no doubt, that when the regulations take effect in May, there will be several, if not many, sites that are going to jump into that, into that world and do Title III crowdfunding, portals. The Title III has specific rules for those crowdfunding portals. They have to jump through a lot of hoops. It's actually not going to be easy, and a lot of people are saying, why would for example, you have to be licensed as either a broker-dealer or the special new category of crowdfunding intermediary, and their due diligence requirements are going to be pretty high, and some people are saying, why would any broker-dealer risk doing this? It remains to be seen whether, I have no doubt that when May rolls around, there's going to be a lot of them out there. People are saying that there's going to be some rapid falling away of some of these, and we might end up with just a small number that will dominate the market going forward. But again, this is all speculation. Right now, I don't know of anyone who's actually planning to do it.
So there is some inherent risk in being an early adopter of this, obviously.
Well, I'm talking about from the portal's point of view itself.
Right.
If you're talking about setting up a Title III crowdfunding portal, oh yeah, there's risk. I'm not sure I'd recommend that to anybody, frankly.
Yeah.
But someone will do it. And if you want to do it, more power to you. I think that's awesome because there's a lot of potential here. I don't think that makes it more risky for the companies using them.
That's right, man.
Yeah, no, the companies using them, it's not a particularly high-risk way to invest, I don't think.
Okay. And is there an opening date and a closing date to these offerings?
Good question. Typically, when we do a direct public offering and you actually get a permit from the regulators, the permit is good for 12 months. So you have the whole year, and that's typically enough to to rev up your campaign. It's going to be a campaign. Get the word out, bring in the investment, and do talk to crowds and put the word out on social media. So it's a process, and mid-year is usually sufficient. We have some clients that do their direct public offering for a year, and they get to the end of the year and go, well, we want to keep it going. So we can renew it. We've renewed, a couple times, year after year, for some clients. Particularly, for example, if they have a nonprofit investment fund or something, then they really have to keep renewing every year because it needs to always be open for investment. So there's a lot of flexibility there. Are we running out of time?
Is there any legal limitation to register with over-the-counter broker, for example, once we have done the DPO and have the shares actually liquid?
That's a good question. Truth is, I think it probably can be done. We haven't seen anyone do it yet. And so I couldn't tell you what the process would look like for that, but I think it probably can be done.
The secondary question is, what are the risks actually for the company doing the DPO? So if the regulators find any discrepancy from the rules or deviation or something happens, what are the risks? Like, are there any very big fees that are going to be paid, or penalties, or risk of being sued, as an executive officer,
Well-
going to jail. We didn't discuss any of.
Yeah, I mean, any company committing fraud
Oh,
is.
outside of the fraud.
Okay,
complex,
all right, so you're talking about, I mean, if things don't go as planned, if you miss your projections, that's not fraud, and that's,
Didn't work out.
it didn't work out. Sometimes things don't work out. I mean, if there's fraud, then yes, there's penalties, potential jail time. But, if there's no fraud, companies do sometimes fail. And like I said, we haven't had a client fail yet, but I'm sure it'll happen.
No big fees in the current law, where they say, okay, if we catch you doing this or you fail to comply with that, you owe us $50,000, $150,000.
There's nothing like that, but we'd have to look at the specific situation. And, if they don't do what they said they were going to do in the offering documents, then arguably that's an example of fraud. I mean, you've got to make sure that what's in the offering documents, what investors are reading and basing their decision on, is actually true. But, when you're talking about your intentions and projections, I mean, we always put in all the disclaimers about, well, forward-looking statements, it's no guarantee. You say this is what we intend to do, it doesn't mean it's not guaranteed. So, and that's true of any investment. So I don't think it's any more true here than in any other area of investment.
So I checked out your listing site, cuttingedgex.com, and I see your own company is listed on it. So you did a DPO?
We did. We've actually done a couple of DPOs, yeah.
For your own company, can
Yes.
you give us some details about how that went? How much did you raise, and where did you find the investors, and how long ago was it, and so how do you pay them back? Or?
We actually done a couple of them. And partly because we wanted to go through the process ourselves, so we know what we're talking about. And it was, it was a good experience, and we have, I mean, the people who invested are the people who we have a good relationship with, and they still support us, it took some work to bring in the investment. We did events where we invited everyone in our network, and they'd come, and we served some free breakfast or something. But the money came in, and it was it's a good experience it was as a way of connecting with our community. That's part of the reason we wanted to do it. It's helped to sort of engage our community. And we're part of a great community. People like what we're doing, they support what we're doing, and a lot of them wanted to invest because they like what we're doing, regardless of what financial return they're offering. So I would say it was a good experience.
Regarding fee, do you work on a contingency basis, or are you pure cash out?
No, actually that's forbidden. We're not a broker-dealer firm, and so we charge for our services on a fee, based on the work that we're doing, not based on the amount raised. We can't actually charge anything that's based on the amount raised. That would, that would be illegal.
I have two questions. The first question is, you mentioned in the 80s, DPOs were popular, but these days we don't hear about them. If you would have to name a reason why they are not popular these days.
Well, yeah, I mean, we often scratch our heads and wonder, why is this not more popular? Because it's such a great way of raising capital. You can engage your community, it has all these benefits. Why is it not more common? I have a rather cynical explanation, and I almost hate to say it, but I'll go ahead and say it anyway. I think it's not more popular than it is because law firms don't like to do it because it's not very profitable for the law firm. And it's not very profitable for us either. But we do it because it's part of our mission. We're trying to build this more equitable economy, and you can't have an equitable economy unless you have more opportunities open up for the non-accredited investors of the world. So we feel like this is an important part of creating a more level playing field in the economy at large. And so we do it. But most law firms, I have a feeling that when clients go to their, the big law firm and say, hey, I heard about this DPO, what do you think? They probably say, no, don't do that. Because they don't want to deal with it. They don't know how to do it, and B, they have a feeling it's not profitable. So anyway, I know that probably sounds a little bit cynical, but that's what I suspect the answer is.
Any other reasons, like it's not people are afraid or not much knowledge about it, it's not as common.
Well, yeah, I mean, it's not well known, and so most entrepreneurs who are looking to raise growth capital, it wouldn't even occur to them to ask. Because the conventional wisdom is you have to go to, either your friends and family, or you go to the big institutional investors, or you get a bank loan. And there's nothing else. That's what is widely assumed. And people don't even know that there's another option. So part of our mission is to get the word out that yes, there is a way. You can actually raise capital from your community. And so we're still trying to figure out how to get that message out more broadly.